Good morning or good afternoon, wherever you may be based currently. Welcome to an Ethical Corporation webinar on investor-driven ESG disclosures. I'm Ed Long, the Project Director at Ethical Corporation. Investor pressure is a hot topic within the space at present. It's becoming as an important driver to change as regulation and technological innovation. The interest from the investment community in the environmental, social and governance of a company is only going to increase. Requiring higher levels of transparency from sustainability practitioners. What do investors expect from your ESG disclosures? So to help answer that question today and help you deliver investor-driven ESG disclosures, we've got 4 representatives tackling the issues head-on. We're going to be covering getting the right data, what do investors want, closing the transparency gap, the reporting landscape, tackling ESG reporting fatigue, how do investors use third-party information to make decisions, and the potential impact of technology as well. Today joining us we have Matthew Welch, who's the president of the SASB Foundation, Ali Weiner, who's an ESG investment strategist at State Street Global Advisors, Samantha Ping, vice president, head of ESG issuer communications at MSCI, and this webinar is going to be moderated by Mark Toulet, who's a director, strategic investor initiative at CECP. Today's 1-hour webinar will be in the form of a panel discussion led by Mark. On the right-hand side, you will see a box where you can post your questions. We want to make this as interactive as possible throughout the hour, so please do post your key questions throughout the discussion, and we'll hope to get these answered in the hour-long session. Lastly, just one thing before we kick off. You may have seen that this webinar has been put together in association with the Responsible Business Summit West. It's a conference we're running later on this year in San Diego on October 9th and 10th. The event's bringing together 250 sustainability professionals to tackle how companies can lead towards a clean, inclusive economy. This topic of investor-driven ESG disclosures will be covered. If you'd like to learn more, you can email me at ed.long@ethicalcorp.com or go to events.ethicalcorp.com/RBS West. Now I'd like to hand over to Mark, who's going to be leading the discussion. Welcome, Mark.
Thank you, Ed, and thank all of you for taking the time to join this very interactive discussion. No PowerPoint slides, so that's good. And then second, we're going to make this, as we said, as interactive as possible. So please do use the chat function, and we'll be working through those questions as best we can. So I'm Mark Toulet. I'm with CECP, which stands for Chief Executives for Corporate Purpose, and I head up the Strategic Investor Initiative there, which looks to bring long-term investors together with long-term focused CEOs to reorient the capital markets. And I'll start with a quote from Gandhi, because you can never go wrong with that. And in 1930, he was asked, "What do you think of Western civilization?" And he replied, "I think it would be a good idea." So what would Gandhi say now, where we're facing the consequences of climate change, environmental, and even presidential degradation, and the list of ESG woes goes on? And at the same time, there's been considerable progress, amazing progress, in innovations, especially on the investor front. Which brings me to today's stellar panel focused on what do investors expect and how do all stakeholders push ESG disclosures forward? Is it the best of times or the worst of the times, or both? We'll get some insights from our esteemed panelists today on that. So I'll start by kicking it off with a general question to everyone about what information are investors seeking from companies in terms of environmental, social, and governance disclosures. What are the emerging priority hot button issues and why? So Matthew, maybe you can go first.
Sure, thank you, Mark. Well, today we've got a huge gap between the book values of a company and the market values that you see. And investors are increasingly looking for information that's not contained in the traditional financial statements. What will explain the market values? And ESG factors are a huge component of that. So they're seeking the information that doesn't show up there, and they're looking for information that will influence investment decisions. So what we here at SASB as we interact with investors, all of whom may have slightly different angles and approaches and ways of considering companies, But among those different angles, all of them care about the financial materiality of issues. They want comparable, consistent, and decision useful information, the kind of thing that they can plug into a model in the same way that they can earnings and other important financial metrics.
Thank you for that. Ali, anything to add there?
Thanks, Mark and Matthew. So I would underscore what Matthew said absolutely about sort of the gap between where we are and where we want to be, and also very much agree with the point of investors, what we're looking for, what we think of as good data, whether it's ESG or not, is data that's financially material, comparable, consistently reported, and that really, as Matthew said, that we can sort of compare companies and their practices across different dimensions. What we see as kind of solving that gap, why we're big fans of SASB, is we see, investors need a common framework for how they can look at those issues in a consistent way. And so when you think about sort of what are investors looking for, at this point, we're focused on standardization of ESG information to sort of get to that vision. I think we see SASB playing a really big role in the market in terms of helping to provide that common framework on financial materiality to help get us there.
Thank you. And Sam, from MSCI's perspective, do you utilize the the SASB information, and what do you see investors seeking for companies, and what are some of the hot button issues that you're hearing from your clients?
Mm-hmm. Yeah, a great question, and good morning, good afternoon, and good evening, everyone. Happy to participate in today's webinar. I think I would also echo a lot of what both Matthew and Ali mentioned. I think what investors are looking for is from companies is really business relevant information. So focusing only on those issues that are determined to be or determined to have a material impact on a company. Now, I'm not obviously. Today's webinar isn't the time to get into the MSCI methodology, but we do have a standardized way to kind of figure out which issues are important to each industry. And what we found, of course, is, and if you're familiar with our research, most industries only have 4 to 7 ESG issues, maybe 8 depending on the industry you're in, that are relevant or are key. What's relevant to one industry like mining may not be relevant to another like a financial service company or a pharma company. So the issues are different, and I think companies need to understand that, and they need to understand their own business in order to focus and prioritize. I do also think it's important to understand in general that not all investors are looking for the same type of ESG data or ESG analysis. I think the spectrum of ESG data and research that exists or that are available really spans the spectrum of the investor needs and investor objectives. Just very quickly, if you're looking for some practical areas, or at least the areas that we see emerging most recently in terms of information that investors are interested in, I think a lot of investors are asking about the SDGs and how companies are reporting on the SDGs and how they're addressing impact. Other themes, of course, climate is a huge hot button issue, and then I think diversity is something that I personally think is going to be up and coming, particularly as it relates to human capital and talent management.
Yeah. So let me paint a scenario and tell me why I'm wrong. So companies are facing hundreds of surveys, and they're being asked to conform to the alphabet soup of standards, SASB, GRI, integrated reporting, CDP, all worthwhile, excellent organizations, but companies I found, are confused about which standard to follow, which rating to engage with, and why. What advice would you have for the group? What advice would you have for companies that are kind of sorting through this and trying to figure out what's the future state is, and what's the strategic fit of all these initiatives? Anything, maybe Matthew, you can talk about some of the work SASB is doing in that area, and others can chime in, because I hear that a lot.
Thanks, Mark. Yes, it's definitely a problem, and I think it's a problem that comes from a good place, which is where we started, that there's a real need and a hunger for high quality ESG information to inform all sorts of decisions, but especially investment decisions. And that practice has been building over the years, and it's created lots of experimentation and different efforts and opportunities. But we're at a point now where the future needs to move toward, as Ali said, standardization on a couple of things that will help to focus the disclosure space so that we get comparability among companies, that you've got different companies within industry using the same kinds of standards and reporting efforts. So how do we get there? I think there's two sides to it. One is on the reporting and framework side, and we are doing some work here. SASB, our friends at GRI, CDSB, and others are engaged in a project under the auspices of the Corporate Reporting Dialogue to map the alignment between our frameworks, better articulate similarities and differences, and look for opportunities to perhaps harmonize them over time. So that'll be a helpful effort. But the reporting frameworks are only part of this whole set of asks that companies have on their reporting. The individual questionnaires, the ratings agencies, the other things go beyond the voluntary reporting frameworks that we have and are additional calls. And so I think it will be interesting to see how that space changes over time. If more companies start to converge on one or two sets of standard reporting practices that they do in a voluntary way, can some of those questionnaires fall away? Does that create the foundational layer of data that folks at analytics firms like MSCI and others could use to create their ratings on top of, because there is certainly a role for both. So I think we're going to see both parts. The standard setters are working to try to clean up the space a little bit, and that's part of it. The other part, though, is companies really determining what are the few things that really matter to their stakeholders, investors among them. All companies have investors and want to provide them high quality information. And as companies choose which things they will do and which things they will not do, that will also help to move us toward more clarity.
I lost the sound. Is anyone there?
Yep.
Samantha?
Yep.
Samantha, do you have a perspective on that? I think Matthew dropped there.
I'm here, Mark. Can you hear me?
Now I can, yes. Thank you.
Okay. I think I actually just finished my sentence, is all. I hope you heard
Oh, okay.
Yeah.
Okay, thank you very much.
I mean, I can chime in from the perspective of, a ratings firm. I think there's a distinction to be made between the kind of the reporting guidance or framework landscape and how that can be sometimes overwhelming to companies in choosing how to report and what to report, and then the issue of kind of survey fatigue from research firms or analytics firms and ratings firms such as MSCI. So I think on the reporting landscape and kind of reporting fatigue or being overwhelmed by the alphabet soup, I think companies also have to take a look at the goals and the audience of the different types of frameworks and understand whether or not it matches their goals and their business needs and who their audience is, because a framework like SASB obviously is directed at investors or for investment purposes versus another framework like GRI, which has a much wider group of stakeholders that are involved in that. So and companies themselves have to report to different stakeholders, not just their investors, but also their employees and their customers, et cetera. On the I don't know if we want to pivot to the survey fatigue issue. I definitely think that also is very real. It's something we hear from companies on a regular basis. They're inundated with requests to data verify and review information for a lot of the different ratings and research that's out there. I think for us at MSCI, our position is one, we don't do surveys or blank questionnaires or stock questionnaires. Our team does a lot of the data collection ourselves, and it's part of our due diligence process to have companies review that information. That being said, I can recognize and I understand, having been part of our issuer communications team for the last 6 years, it can be an onerous process, and there are definitely some pain points along the way, which we are investing in technology and in resources to kind of ease the pain a little bit for companies. We have a dedicated portal now where companies can access their own reports, access a wealth of resources to help companies navigate the ESG investing space, particularly the work that MSCI does, and eventually very soon digitize the whole feedback process, so not having to take hours upon hours to add sticky notes to PDF reports and stuff like that. So from the perspective of MSCI, that's what I can say that we're doing, and try to help alleviate some of that fatigue that companies are facing.
Ali, do you have a comment on this before we open it up to? There's some questions we're getting in the chat. I'll turn it to next.
Yeah, absolutely. I think very much echo some of what's been said. And if I go back, from the investor perspective, what is the impact of companies facing that very real challenge of the alphabet soup of reporting? I think goes back to your first question, that the impact of that is that the data that goes out in the market is not standardized data. We get different things from different companies, even from companies within the same industry. And so, our job as investors is to help, I think, streamline the message of what is that financial material information that we expect of companies. So this is, when we looked out at the marketplace, we really didn't see that message being shared with companies in a unified way, exactly to your question. So not a pitch for SSGA, but just to share a little bit of what we've been working on and how we think about this. We've actually just launched an ESG scoring system that's intended to do that, that's intended to provide a consistent message to companies of kind of what is financially material. And the ESG scores are based off of the SASB materiality framework. So transparent frameworks where companies can understand exactly how they're being scored. We also leverage corporate governance codes, but for the purpose of this conversation, it's sort of a transparent source so companies understand what are investors' expectations. And I think just as importantly, companies know, if you go to the SASB website and you can sort of identify for yourself which pieces are relevant to your industry and start to work through making that disclosure public, it really streamlines what you're reporting to investors. So very much second, I think, the point Sam made, that companies have a wide variety of audiences, and certainly investors aren't the only folks that they should be reporting to. And so we think of SASB as kind of a floor and not a ceiling. But our hope is that by providing that to companies, we're really trying to say, if you only do one thing for investors, do this, because this is the most decision useful information for us from an ESG perspective.
Right. Yeah, very helpful. It's a high floor for certain.
Absolutely.
Question from Kimberly for Sam and Matthew. How do you advise companies to address completing materiality assessments? Is that important anymore?
From the SASB perspective, we've always thought about our standard setting and our work as being consistent with the existing obligations and practices of companies to consider the materiality of issues that impact operations and financial condition of the company, and then disclose that to investors. So that's the framework that we use. We don't use a different style or a focus. And so, at least from the SASB perspective, that process should fit into a company's existing approach to considering the materiality of issues. I'll also say that, and this picks up on what Sam said earlier, materiality is industry specific. What is important and is going to have a critical impact on financial condition or operating performance of a company is going to vary. It's one set of issues in airplanes, it's another in banking, and so on. And so the company can look at a set of standards out there. I certainly would recommend SASB, but also GRI and whatever else may be relevant, and then consider that as the starting point to look at those issues. And then companies determine for themselves, does this issue have a material impact on our value creation over time? And you would do that in the same way that you look at other non-ESG issues.
Right. Go ahead. Someone was going to comment.
Sure. I was just going to state that I think it's important. I think it's still important for a company itself to go through the exercise of, internally understanding what's material to its business. I think that's important for any company's, sustainability journey and really integrating it into the business. As maybe a bit of a cheat tool, if you will, like MSCI is, and I think even, SASB as well, we've already identified, we've gone through methodology to identify those issues that are most material to a company. So if you're looking for a place to just start, I think looking at, your MSCI report, which companies can get at no cost from MSCI, is something that, I would do, if I was a company and I needed a place to kind of get going on this.
Right.
I'll just add one more thing, if I may. Sorry to be back here, but I would also add that I think when this is best done, it's a collaboration between the sustainability professionals and the finance professionals and perhaps the legal professionals within the company. It should be an integrated process because, as Sam just said, this is part of the business strategy. It's about creating and maintaining value over the long run. So I don't think it's a separate exercise done just by the sustainability folks to produce a sustainability report. It should be part of the ongoing corporate strategy and then communicating that strategy and performance against the strategy to investors.
And if I could maybe this is Allie, if I could just build on that, very much agree. And from our perspective, just as important that as you go through that process, as you start setting up those internal mechanisms to understand, what's material to your business, how you're going to measure and report it, that information makes its way to management and the board so that they have sort of a fuller set of information with which to make decisions, right? Very much trying to link that back to how that strategy gets executed.
Another question from chat functionality. So far, many of the disclosure regimes are voluntary. They actually all are. Do you see a role for standardization via legislation in the U.S. in particular?
Happy to take that one. I would say that, Mark, you're 100% right that currently use of a particular framework is voluntary. That's a company's decision. But I will say that the regulatory regime, country by country, is moving and changing and evolving in the direction toward more compulsory sustainability disclosure, in some places faster than others. Certainly Europe has done a lot with its directive on non-financial reporting, and new rules are being considered in different markets all the time. What we do at SASB is to engage with regulators, both in the US and elsewhere, not to ask them to create new regulation and new disclosure requirements. At least for our purposes, we think that the existing disclosure requirements, which discuss disclosing material information to investors, are sufficient. But we want to make sure that regulators, stock exchanges, policymakers understand the role that SASB and other frameworks can play in helping companies to meet those existing, emerging, and increasing obligations that are out there.
Yeah. Thank you for that. And another question coming in. This is great. All these questions are coming in. I was wondering if there was going to be enough questions, and we have so many. This question for Allie. If boards are in the U.S. can be categorized as male, pale, and stale, perhaps rusty, crusty, and dusty, what is State Street Global Advisors work in the diversity inclusion area, and how are you addressing this issue?
Sure. Was that some of your editorializing, Rusty Crusty? So thank you for the question. Many of you may be familiar with Fearless Girl, the statute that we put up a couple of years ago of a young girl facing down the Wall Street Bull. She's now been moved to her more permanent home across from the New York Stock Exchange. Really, that as that campaign was a signal of the firm's commitment to gender diversity, broadly and specifically at the board level. So this is an issue that our asset stewardship team in particular began focusing on a number of years ago, really out of the recognition that the research done that cognitive diversity at the board level ultimately had a link to long-term sustainable financial performance, right? So companies who have some diversity are doing better financially. So with that, we, I believe it was 2 years ago, started notifying our portfolio companies in a number of select markets that we would start to vote against director nominees in certain markets and companies where that board was entirely male. And our ask for those portfolio companies was not, I think, outlandish. It was, as a start, just nominate one woman, have one woman on your all-male board, which we felt was fairly reasonable. And put out some thinking of how of our rationale for that. So the campaign is now in its second year, and we have identified about a little over 1,200 portfolio companies that we've sort of identified as not having a woman on their board. The campaign has been very successful. So
Sorry, can you repeat how many companies have you identified? Can you say that again?
A bit over 1,200 companies globally.
That's a huge number. But go ahead.
Huge number. So that's over the last 2 years, I think the positive story is that about 35% of those companies have either nominated a woman or, in a very small number, have committed to doing so. So about 35% we've seen progress on this call to action, which we think in a 2-year span is really is positive, although obviously much more work to do. And then we honored our word, and where portfolio companies did not add a woman in those markets where we communicated the expectation, we voted against director nominees of all, or male director nominees of all male boards. So have voted against approximately 500 in the first year and 600 in the second year director nominees. So really, if I take a step back, what our stewardship team always tries to do is use all of the tools at our disposal in working with portfolio companies on our goals. And here we very much use both our voice and our vote to sort of back this campaign. And it's something that we remain committed to.
That's great. Sounds like a long overdue and very important effort. So thank you for that. Another question here is, what is the role of technology in improving ESG disclosures? Question from Olga. So how is technology, is the artificial AI going to be the new normal?
I can maybe add something to that. I think, at MSCI, we're definitely we're a technology company, and we're definitely looking to leverage AI and natural language processing to I guess, plug some of the gaps in data that's out there in terms of the ESG information landscape, which I think needs to be distinguished from voluntary corporate disclosure. Our assessment itself isn't and it isn't a disclosure-based assessment. We are looking at data beyond just company disclosure, and so a lot of our alternative data sources are really coming from or are possible because of technology. We're looking at satellite imagery and social media and mining like earnings call transcripts, or at least exploring stuff like that. So I think technology will allow the investor community to fill some of the gaps that are currently exist because of the lack of standardization and the stark difference between different types of reporters, or where companies are in their reporting journey.
I'd love to offer a counterpoint to that. This is Matthew from SASB, and I think that's a reasonable activity for investors to do, to look for, which investors do today, right, is to look for information beyond what the company reports. But I would suggest that for companies, that's not necessarily a benefit to you. It may feel like it reduces the reporting burden, but on the other hand, it turns over then the storytelling and the data supply for investment decision making to other activities. My view would be that companies, by improving the robustness of the disclosures they choose to make, can better control then and influence the decisions, outcomes, analytics, scores, and ratings that that are made in favor of your company. So I would not suggest that turning things over to AI is going to be in the company's best interest. I think it will be in the company's best interest to drill down to the critical set of topics that are of interest to the investor community, doing great disclosures on those. And where I think technology can help that is, for financial disclosures, companies, at least in the US and in other parts of the world, make their disclosures eminently available to investors through XBRL tagging and other types of markup that allows investors to ingest that data into their systems without any sort of mistagging or loss of information. To my mind, that is sort of the ideal, is that companies can put out the information that they believe tells their story the best, and that there's no sort of transmission loss or mistranslation in its use by investors.
Right.
Yeah, and if I could just actually add to that, and I would agree with Matthew in the sense that I don't want it to it shouldn't discourage actually companies from reporting. I think corporate report disclosure is still very important. It plays a major role, definitely in our assessment, and we are in search always of better, meaningful data. But I think for companies, at least if you're a company, knowing now that investors are looking at these alternative data sources, it should motivate companies to look closely at what they are reporting and kind of remove the fluff, if you will, and ensure that what they are reporting is targeted and it is relevant. And it's an opportunity for companies to refine their messaging to investors.
And along those lines, there's another question that came in and said, is standardization really possible and practical on this for this type of information, or are we just heading down the wrong path? Is what the question is. So speak to the kind of topic of the goal of standardization, and maybe Matthew, speak to how you're working on that kind of globally now.
Sure. Well, I have to believe that standardization is possible, or I'd be talking myself out of a job. But I think that the person asking the question makes a good observation. It's exceedingly difficult, certainly with ESG topics, more so than straightforward financial numbers, revenue, costs, et cetera. We find in our SASB standard setting process, it has been our goal to have a large percentage of our metrics be quantitative so that they can more easily fuel investment analysis and therefore investment decisions. We want numbers that analysts can plug into models just the same way that they do with financial data. But the other 20% of metrics in our standards are qualitative because context does matter. You have to go beyond raw data to consider what is a company's approach to managing that issue, what is the strategy behind it, what do they view as the competitive landscape. And so about 20% of the metrics within our standards are these qualitative, more discussion and analysis type of responses. So I think both are important. I'd be curious to hear what Ali thinks from the asset management side about what the promise is there. Certainly it's a harder task than ingesting financial data alone, but an effort towards standardization means that we can start to move away from, I think, the current state in which if you look at different ESG ratings and rankings, you will find, 4 different firms will cover the same company in very different ways. Some will consider company A leader, others will say they're a laggard, others will say they're in the middle. And that's in large part because there is not a standard set of data that's being used. There will always be interpretive differences, we want that. But if you don't start with a standard set of data that is being considered, it's very hard to arrive at directionally consistent analysis.
Yes. Allie, do you want to weigh in on that?
Yeah, I think I feel like your cheerleader, Matthew. I would very much echo those points. We do think standardization is possible, and to some extent, I wonder, going back to something I had mentioned earlier, I wonder if standardization partially feels hard because these aren't necessarily metrics that many companies are used to collecting and managing in a consistent way and in the same way that they would manage sort of standard business risks. And so I think when companies have further built out the infrastructure, not just to do the data collection, right? Companies have been putting out sustainability reports for a long time, and that can sometimes feel like sort of a sprint to collect a bunch of data, some of which is material and some of which isn't. But when companies are in the rhythm of building that internal infrastructure so that this is managed in a consistent way, and boards, management teams are comfortable with starting to report out that information, I do think that SASB has made a tremendous contribution to the field in articulating what that standardization could look like. And I can give just an example of what this means for us, how useful it is to have that materiality framework when we're looking at companies that we're invested in. We saw an example recently using our R-factor scores that I described earlier. We saw an example recently with a company that this is an electric car company and bills itself as quite green. And when you look just at their top line R-factor score, using that sort of financial materiality data, just the top line score looks sort of roughly in line with their global peers and their peers within their geographic region. But when we sort of unpick it and we look at some of the general issues that SASB identifies as material within that industry, there are some real sustainability risks to this business. And so helpful for us from a decision-making framework to say, is this really a green company if actually they're underperforming their brown peers in their industry? And so, the standardization is not really an abstract conversation for us. It's very much what allows us to have those concrete conversations about company performance and how, ESG performance, but ultimately how that ties to financial performance. And I do think already we're making progress to get there.
Yes, thank you for that. And we have another question here, and it's interesting. It's a little bit of a pivot here. What's the recommendations that you have for small and mid-cap companies that are kind of just coming into this and they don't have the resources of the larger companies to respond and maybe engage as they should? Is there any recommendation you have on kind of where they should start, and secondly, how does this, do the ratings change if it's a smaller or small cap versus a large cap? Those are the two questions.
I can maybe kick us off here. So we hear this question a lot, and we are very aware that across the board coverage by ESG data providers of small and mid-cap companies is not as robust, that the disclosure from those companies isn't always robust. I think what we would say is if you only do one thing, I think do what we've described on this webinar. So take a look at your SASB, at your industry's SASB, what SASB defines as material, what some of those general issues and the specific metrics are, and start to analyze your practices against those. I think, part of what we're doing with our R-factor scores is sitting down with companies and sharing their scores, and then they can use that information to start to build out those practices and increase disclosure. And I think that materiality map offers a really streamlined way of just asking for a couple of pieces of relevant information.
Right. Yeah. Anyone else want to weigh in?
Yeah, I can add to that, at least for the second part of the question in terms of how size plays into, a rating. We do account for size in many parts of our assessment in terms of our scoring model. I also would comment that we're pretty clear, I think in our approach and our methodology that more disclosure, does not necessarily mean a better ESG performance, and similarly, no disclosure does not necessarily mean that a company is a poor, ESG performer. Again, because our assessment isn't solely disclosure based, so our model does account for, in many cases, a lack of disclosure, which for a lot of smaller companies, they haven't had the resources to build out, a sustainability report or get their reporting in order just yet. I will say though that greater transparency, however much there is, especially versus none or very little, can help refine, our evaluation, better integrating, and understanding context when we're assessing a company. I also think that, when companies at least make the effort to go through these exercises and understanding what they should report and seeking to report more, it does force them to hopefully meaningfully look at these issues. And I think from there, it's kind of a snowball effect that, eventually, as their reporting is refined and they start to report on progress and start looking at progress and start looking at this as a way, in a more integrated way to their business, that performance does follow in that regard.
Right. Yeah. And does better reporting lead to better performance? And do we have enough transparency? There was a question that said, are companies being transparent enough? Or is it a question of a measurement issue that we're struggling to determine what is financially material and why? So what would you say to that question?
I would say that transparency alone does not solve it. We've had a lot of transparency over the past 20 years, increasing transparency around a bunch of issues. And in some cases, that has improved performance on some issues, but certainly not all issues. And I think that that is part of this maturation of this discipline, of this field. SASB was founded coming out of some research at Harvard's Institute for Responsible Investing on a paper authored by three folks, including SASB's founder, and it was called From Transparency to Performance. And it argued that while transparency had increased, performance on sustainability issues had not yet increased, and that the reason was there was not a yet agreed upon approach or set of standards for what mattered, what were the sustainability topics that drove performance. And so that's what SASB set out to do with the focus on financial materiality and industry specificity. And we believe and have seen and done some case studies on better reporting can lead to better performance if it's reporting on the things that matter. And so we believe strongly in financial materiality as the starting point, not necessarily the ending point, but certainly that's got to be an intense focus, because if you are focused on reporting the issues that are financially material to your company, you're going to manage what you're measuring, what you're reporting to the outside world, what your investors are hearing and seeing, and therefore making capital allocation decisions based upon. That always moves the needle.
Right. And Sam, are you getting all the information you need at MSCI to make the ratings and indices? Are we halfway there? Where are we on that spectrum?
I think there's still probably a long way to go. We rate thousands of companies, and definitely not all companies are in the same place in their reporting journey. One day I'm talking to a company that's never issued a sustainability report, and then the next day, you're talking to another company that's been doing it for years. But it is obviously every year we're noticing more and more companies that are starting on that reporting journey. But there are still gaps, even within industries. And long-time reporters, there are still issues with, as we've been talking about today, the issue of standardization. So I do think there's a long way to go. And, we, as part of our model, again, because our goal is to assess ESG, performance, we do have to do some standardizing ourselves and normalizing of the data, sometimes a lot of massaging of the information in order to get comparable data. And then, like I mentioned earlier, we are, in order to fill some of those gaps, that are made by, or within corporate disclosure, we are leveraging alternative alternative data. I also think, we also think, in order to provide investors kind of an objective risk signal, you can't necessarily solely get that from corporate disclosure and corporate's own narrative and how, that kind of corporate filter data. So we are looking at, other sources. Again, the ESG information landscape is much larger and goes much more beyond, I think, corporate reporting.
Yes, thanks for that. Another question related to transparency from John. How has public ESG transparency most influenced corporate behavior in both obvious and non-obvious ways? And obviously, Ali, you spoke about how that your campaign has had that 35% rate in adding board diversity. Are there other examples that we can think of and share?
Yeah, absolutely. So we, we are certainly not unique in this. In addition to diversity, I think Sam started by talking about climate and the focus that investors have had recently on climate. And we haven't talked much in this conversation about the Task Force on Climate-Related Financial Disclosure, the TCFD, but that feels like sort of the other looming framework here as an obvious example of a space where when companies are provided with a consistent message of what investors expect to see with respect to ESG disclosure, it allows for more information in the marketplace and ultimately better decision making so that investors can be building responsible investment solutions based off of kind of stronger company performance in that area. And I do think you've seen, in the climate space, the push for greater disclosure influencing company behavior and kind of encouraging advancement in that area. That's the other big one I would point to.
Yeah, and Matthew, since we were talking about TCFD, maybe you could share how you're working with SASB, and also maybe the larger question about harmonization efforts overall. If you could share a little more insights into what you're doing to help address some of these issues that have been brought up today.
Sure, and I'm glad TCFD has come up because it's been a real focus and area of interest for us at SASB over the past couple of years. And there are lots of links between our organization and the TCFD advisory board and secretariat. The Task Force on Climate-Related Financial Disclosures has done really important work to help focus and distill corporate and investor perspectives on what is critical to climate risk. SASB was an important input to their work, as was CDSB's work, the Climate Disclosure Standards Board. And it's not surprising. SASB standards certainly are broader than climate, but we find that climate is the mega issue that pervades nearly every industry. We find climate risk manifests in one way or another in 93% of our 77 industries. So it's fully there. SASB has worked with CDSB to issue an implementation guide to implementing the TCFD recommendations. We came out with that in May, and it's gotten some great uptake. And that really comes out of companies that have signed on to report against TCFD recommendations, but felt they needed more concrete guidance on how to do so. SASB and CDSB felt we were well positioned to provide that guidance, in part because when the TCFD was doing its work, it pulled from both SASB and CDSB to do it. And so there's a natural fit there. And so to Mark, your question of the broader harmonization efforts, I think we're starting to see some great alignment, especially among the frameworks like TCFD, SASB, and CDSB, those that focus on financial materiality. Clearly, there's a good synergy there. I think there are good opportunities to harmonize elements of what we do, and we're increasingly communicating that to the market. And then I think there's another set of harmonizations that can happen with the broader frameworks that focus on impact that goes beyond financial materiality. So you think about GRI there and impact against SDGs and so on. So that's part of where we are. And as I mentioned earlier in the call, we participate in the work of the corporate reporting dialogue to make sure that all of these sustainability standard setters, that we're being thoughtful about how to make things more simple and bring things more together over time.
Yeah, thank you for that. It sounds like there's been some excellent strides towards alignment and bringing market clarity, which I think I've heard has been widely recognized and appreciated. Another question here on, so we didn't talk about the role of the board of directors in driving ESG disclosures and improvements. What is the role of the board of directors, and are they doing enough now to address the sustainability challenges, climate challenges?
I'm happy to take a start here and say that, we see the role of the board as managing the risks and opportunities, the business risks and opportunities facing a company, and really owning the governance of those. And so to us, very much the theme of this conversation has been, how do we start looking at ESG risks and opportunities in the same way that we would look at any other business risk and opportunity? And so our expectation is that the board is managing those risks. We understand that that's sort of an ongoing process of internal board education and familiarity with some of these frameworks and financially material issues, and ultimately a question of setting up internal processes. But we see boards do this in many different ways in terms of dedicated sustainability committees or folks focused on sustainability versus it being kind of dispersed within other roles of the board. But we very much see that governance role as part of a board's responsibility.
Absolutely. I would add in that we certainly see this as an important responsibility of the board of directors, especially given that management is managing for the today and the near term for sure, but it's the board that has the special role to really be stewards of the long-term value of the company, and therefore they are particularly charged with how the company is strategically positioned now and countering risks and opportunities over the long term. So from a strategy perspective and charging management with performance against these topics and positioning against these topics, very critical. I think Ali's point of some boards are further than others is so true, and some accomplish that through a separate sustainability committee, and that can be a great marker of the focus and attention placed on this. What we also sometimes see is the audit committee adding into its charter a focus on ESG risks and opportunities, and making sure that disclosures around non-financial topics are also clear and complete. And that's another way to handle that same thing. Ultimately, we'll see where it all lands, but the important thing is that the board increasingly takes a view of sustainability issues and is working in partnership with management to have a strategy and perform against that strategy for the long term.
Right. And final question, as we're kind of nearing the end here. If you could wave a wand and everything you wanted in your business plans, your organization's goals was to come true and to come to fruition in 3 years, what would the future state look like 3 years from now, from a company perspective? Would there be one survey that would just be one survey? There'd be one standard. What would the future look like? And secondly, what is each year's kind of call to action for the companies on the phone today and others? What's the one thing they should do when they get off the phone? So I'll start with who wants to take that first?
I can start. I can start in terms of the will there be one standard or one survey? I think again there should be a distinction made between reporting frameworks and then the analytics and the rating side of it. But I don't think, or at least we don't think in the short term, there will ever be a convergence to one rating. And I think simply because not all investors are looking for exactly the same thing. They have different, like I said, different data needs and different investment strategies and different investment objectives. So there's going to be a need for so that, that's going to be which rating or assessment they look at, or the data that they look at, is really going to be driven by their individual needs. And so that spectrum is quite wide. In terms of call to action, I think it's for us, it's pretty simple. If you've never been in contact with MSCI before and you've never seen your MSCI ESG research report, please, do not hesitate to reach out to us. We do have our dedicated issuer communications team that's kind of here to or is here to help you or help companies navigate the whole ESG investing space. Of course, it started in a place of part of our due diligence process, ensuring that we are reaching out to companies for data verification purposes. But I think in recent years, we've recognized that we're actually quite we're more of a conduit between investors and companies. So even beyond just data verification, we're interested to hear company insights, because I think that's valuable to our clients and valuable insight to our analyst team. So, and if you want a place to start, like I said before, if you're trying to figure out, you're trying to navigate the space and understand which issues you should report on, we've done a lot of the work for you in just our ratings assessment. So, you can start there by looking at your report.
Thank you. Matthew?
Sure. So I think my dream would be, and I'll be agnostic on the question of is it one standard setter or 10, because I think that's less important than moving toward a general market agreement on a foundational set of data that companies and investors agree this is the set of information that we want to focus on. And I think that's going to break down into what's the small set of issues that is material for most companies in a particular industry. And maybe we can even get to some agreement around the set of information that goes beyond that broader impact. I think that would be a real win for the market, and that is my dream, is that we get that simplification so that it's pretty straightforward for companies, that investors are working with the same set of data. And then, as Sam said, adding the analytics and judgments on top of that, as the market needs to do to satisfy different investment strategies and time horizons and so on. My call to action for this group would be to engage with us and participate in our standards development process. We've codified the standards, so we now have a body of standards available for use, but they will evolve over time based on market input. And that's what we're here to be. We're a sort of a public utility, if you will, nonprofit, privately funded, not government funded, but publicly available to balance the needs of investors and corporations. So everybody has a say. So participate in our standards development process. That's how we get the best standards out there. And the second part of the call to action would be to take a look at the SASB standards if you aren't already, and use them as a helpful starting point. In some cases, it may be an ending point, but certainly it should be part of your overall strategy for how you're managing risks and opportunities internally and communicating them to your investors.
Thank you. And Ali?
Sure. I think from our perspective, 3 years feels like a short time frame, but where we're ultimately trying to get to is more sustainable capital markets. So businesses managing these risks and opportunities in the same way that they would any other, and that the ESG data is as available and as accessible as financial information. So I would actually go back to the point that we made at the beginning about that being material and consistently reported and comparable across firms. To us, that's really the vision of the data we're trying to get to, and echo the point of someone agnostic about whether companies only report against SASB or they report against a number of different frameworks. But I think we certainly see SASB as sort of a unified investor voice. So I'd give both a short-term and a bit of a longer-term call to action. On the short term, I very much echo Matthew and would encourage companies to look at their SASB, where they fall in the SASB materiality map, and understand sort of what to be managing and disclosing on. And then just a note that later this summer, we're actually building out a platform for companies to be able to directly request their R-factor scores that I mentioned, so that they can see sort of how investors are viewing their performance, and because they'll hopefully have looked at the SASB materiality map, have a clear vision of how to improve those scores over time.
Thank you. And my call to action before Ed jumps on and wraps this up is to really consider attending the October 9th conference, the RBS conference. It's a stellar conference they put on, and I hope you can carve out time to attend that. And second is to engage. Don't sit on the sidelines. I've been involved in this for 25 years, from the launch of the Global Reporting Initiative to launching several other things. And we welcome your input at CECP and in the Strategic Investor Initiative. So feel free to engage cecp.co/SII, where we're mobilizing CEOs to engage on sustainability and sustainable value creation. And with that, I want to thank you for your time and turn it over to Ed.
Thanks, Mark. And yeah, unfortunately, the time's run out. Thanks everyone for signing into the webinar and listening. And also thanks very much to Ali, Matthew, Samantha, and Mark for leading the webinar. Everyone who've signed up today, you'll receive the recording of the webinar within the next week, so do look out for an email from myself. And we had a great amount of engagement in terms of from questions coming in from yourselves. So, I mean, what we can do, if any of your questions weren't answered, you can raise them. As we said, this topic is going to get brought up in quite a lot of detail in San Diego in October. So if you are interested in joining us and 250 others, please go to events.ethicalcorp.com/RBS West for the full speaker lineup on the agenda as well. Once again, thanks for listening, and I hope to see you next time.